You actually came right in the middle of this decade, and you've been one of the success stories of this decade so far.
Real success doesn't announce itself overnight. It compounds quietly through discipline, patience, and earned trust. Neil Parekh and Rajiv Thakkar from PPFAS Mutual Fund, voices behind one of India's most respected long-term investing journeys, join us on MF Chronicles.
We talked about COVID. See, the local markets everybody knows, everybody has a view on. But you were also investing into global stocks.
Because of this situation, stock prices fell 40%. Most of us ran down our savings account, FDs, put all the money into the scheme. Before the COVID struck, we had about 13% cash that we ran down to 2-3%, whatever bare minimum we could keep. And we communicated to clients, if you have investment capacity, be greedy when others are fearful. Foreign stocks, incidentally, the ones that we own were the biggest beneficiaries of COVID. OTT, video consumption, music consumption.
You said that if you're in a forest and you see a tiger, what can you do? Whatever needs to be done will be done by the tiger. I think that's pretty apt in terms of what happened in 2016 when demonetization was announced.
Obviously, in 2015, our founder passed away. Again, that was a big jolt, and we didn't know how things were going to pan out. So I would say that the first 6 years was about survival. For us, it was that keep doing the same boring things consistently well, and hopefully there's light at the end of the tunnel. And what we set out to do was get people who are sticky with us, sticky investors, sticky distributors.
So whenever there are these problems which have a 3-month, 6-month impact, which causes stock prices to fall anywhere 20%, 30%, 40%,
Yes.
we love those kind of situations.
Please explain a little bit more. Hello and welcome to another episode of MF Chronicles. If 1995 to 2005 or the pre-2005 era was basically an era where the seeds of the private sector mutual fund industry were being sown, 2005 to 2015 was when regulation and structure were coming into place. 2015 to 2025, one would argue that this was the time when mutual funds really came onto their own. You're talking about significant rise in AUMs, product categories which were doing well, started really proliferating, newer mutual funds coming in, the mutual fund Sahi Hai campaign making its debut, and a host of other things. It's indeed a pleasure to welcome the team from Parag Parikh Financial Advisory Services Mutual Fund. Did I get that right? PPFAS AMC or Parag Parikh Financial Advisors? Okay.
By the way,
I will always go with Parag Parikh
Yeah.
Financial Advisors. Yeah, I've got a strong emotional connect. And it's a pleasure to welcome Mr. Neil Parekh, the Chief Executive Officer, and Rajiv Thakkar, the Chief Investment Officer. They are obviously known to all of you. I think a lot of us have heard, seen, read what they're talking about. But what I'm going to talk to them today is how they have seen the growth of the industry, especially in the last decade, through their eyes. So get ready for a host of anecdotes, ideas, insights as we progress the conversation. Very warm welcome to the show.
thank you, Vikas.
Thank you so much.
Okay, so I was just talking about the growth of the industry, and in a way, when I start looking at this period of 2015 to 25, while I talked about the positives, I think there were a lot of roadblocks which came in. There was demonetization, there was COVID, and it's not easy running an open-ended fund at that point of time. Yeah, let's start in cricketing parlance. Since we just won the World Cup, I'm just taking that as the basis of this discussion. Let's go with the power play. Okay, let's talk about the first few years of existence when your firm came into play at the asset management level. Obviously, the firm has a vintage going back right up to 1979. But let's talk about the asset management business. You actually came right in the middle of this decade, and you've been one of the success stories of this decade so far. When you started off, Neil, this was a decade which came on the back of frenetic growth and AUM being one of the defining criterias of success. And here you were, you said, I'm going to tread a less trodden path, if you will. What was in your mind when you started calibrating the growth of this company? You're talking about setting up processes, and more importantly, when you saw the landscape out there, what are the few calls you took? It'll be nice to hear what strategy you employed.
Yeah, so we started our mutual fund in 2012-13. So it is 2 years before the decade we are talking about. But let me just go 2 years before that and why we started the mutual fund, And this was at the back of the financial crisis, one of the things. And global stocks had taken a beating. And we wanted to participate in those stocks, because we thought that this gives a really mouth-watering valuations for entry, and we wish we could participate in that. A PMS wouldn't not let you participate in that, but a mutual fund would give you that flexibility to invest abroad. That was one of the reasons why we wanted to go there. Secondly is that we were also third-party distributors of mutual funds at that point. And at that point, what happened was that there was no categorization of mutual fund and no scheme categorization, or you can only launch one scheme in one category and all of those things. It was kind of a cowboy kind of a way of going about it, where anyone could just launch any scheme and write any title to that, India Shining or any of those things, and launch a scheme. And when we were third-party distributors, the people from other mutual funds would come to us and say that, okay, why don't you distribute our product? So we obviously wanted our clients to win, or what is the best allocation for a client. So we would get down deep, and those people just come with a really fat fact sheet book, and we're like, what's the difference between this and the other thing and the third scheme? And they all look the same. They just sound different, but eventually everything is the same. We didn't get a clear answer as such. And we thought that communication is a big gap that needed to be solved coming down with us, And we said that what would be a structure that would be exciting for us to put our own money, me, him, employees, and a few clients that we had in PMS. What would be a great structure for that, Because right now, people, mutual funds had 50, 100 schemes in their things. We're like, it's so confusing for us as practitioners. How would a lay person even get there and make a wise decision about where you should invest? We're like, let's make it as simple as possible. Can one scheme do everything that everyone is doing? So we thought of a Swiss Army knife. That was the concept. Swiss Army knife is one device, multi-functionality. We're like, can we devise a scheme that will take care of everyone's need? Nobody needs to make any choices. Yeah, these people will do everything. It can become an aggressive hybrid by taking some cash position. We can invest across sectors, across geographies. We could take arbitrage position, do special situations, a whole lot of stuff. So we're like, we don't want to launch more schemes. One of the things is like, let's keep it as simple as possible. And that's how we went through it. One of the inspiration was the Warren Buffett's annual general meeting. And we took inspiration from there. And we're like, there is a clear gap in communication. And if we can solve for that, and people always wanted to know, okay, what are these guys doing? What is the mutual fund? There was not that much information at that point that is right now, currently there. This is social media was also not that much. So these 3 or 4 things made us want to do this. And I think these are the reasons why I think people have seen that consistency that we've been doing it with. And I think today, these are the same reasons why I think that got us a bit of success right now.
It's amazing, people talk about doing market research before launching anything. You were actually doing it on the fly. You were talking to customers, you were understanding from them, and to distill that into such a simple proposition, a Swiss Army knife. Amazing. It'll probably be a little bit of a surprise to you. Way back in the day when we launched mutual funds in the 90s, the concept was the same. कि एक ही fund launch करने का है, जिसमें सब कुछ कर सकते हैं. Of course, not as refined as what you were because the industry was very nascent. But somewhere along the line, I think, like I mentioned, AUM took precedence for the right reasons. I'm not trying to disparage that, but to distill and work on a simple thought, not just in terms of a product, but also in terms of communication. Rajiv, Parag Bhai also used to, for the audience, I used to work with Parag Parikh Financial Advisory Services way back in the day. So I can talk like an insider at times. No reference to what SEBI talks about. This is a different type of insider. Parag Bhai often used to talk about making the middle class rich through long-term investments. Okay. One was thinking of a product. It should be simple, communicating about the simplicity of the product. But at the other end, you probably had a segment of people who, while they came in for the long term, because of the fact that NAVs were declared daily, did not think long term enough. Okay. I've talked to a lot of practitioners. They said that we put in an exit load. Was that also something which you tried doing initially to control investor behavior, or was there something else which you did?
So we have exit loads.
Hmm.
Initially, exit loads were not that much, but we brought them in somewhere when we saw that people are not staying the course, and this is not really a investment vehicle which is suited for 6 month or a 1 year kind of investments. So the average investor stays with the equity mutual fund scheme in the industry slightly less than 2 years. This is the published data. Now, obviously, some people averages hide a lot of things. So some people would be staying very, very long, whereas other people would reading very, very quickly. So from day one, the communication was that give us a minimum of 5 years. Don't even invest with us if your horizon is less than that. So to encourage that kind of behavior, what we did is we put in exit loads for the first 2 years. So at least once that 2 year period is done, that itch goes away to do something. Initially, if people see quick profits or if there's a small dip, that urge to do something is there. Over a period of time, people forget about the investment or then let it run its course.
Why I asked you specifically about the investor behavior was also because at times it affects your investing style. You want them to stay for long term, you want to build it up for long term, you want things to compound. But because sometimes investor behavior can be a little unpredictable, that is one part of taking a few different bets in your portfolio. But in your case, that's why I started with investor behavior. That is obviously not something which you were too concerned about. But in your case, I think the industry was replete with a lot of investing styles. Although we didn't call it at that point of time, there was momentum, there was quality, okay? And you were in a phase, again, to talk about cricket, you were at times letting the good balls go past the stumps just because you knew that you were here for the long term, okay? Take us through your mindset, how you were thinking, building the portfolio, building on your convictions. What was the thought process behind building this entire thing?
So continuing with the cricket analogy, there are 3 formats now, right? So there's the 2020,
Yeah.
there is the one day international, and there's the test cricket, which a lot of young people may not be too familiar with. Test cricket is where the main job is to not lose the wicket.
Okay.
Tire out the bowler. Somewhere a loose ball will come.
Yeah.
Hit that out of the ground, or even taking a single or 2 runs is fine. So why is not losing the wicket or not losing money important? And a lot of people would have heard this phrase but not really understood it well. It's simple mathematics, but people tend to ignore this. So Buffett has said this numerous times. Rule number 1 is don't lose money. Rule number 2 is don't forget rule number.
Correct.
So what does it really mean? Equity is a risk asset class. Sometimes losses will come.
Correct.
Which he refers to as quotational losses.
As?
Quotational
losses. They're quoted, not actual.
Yeah. So if it's just market sentiment, then you can ignore it. So what happens is, if you have bought something for 100, a 50% loss will take the price down to 50. A 50% gain will take it up to 150.
Correct.
But both are not equal. One may think that a 50% gain is equal to a 50% loss. If you have a 50% loss, 100 becomes 50. From 50 to go back to your starting point, you need a 100% return.
Correct.
If you lose 90% of the money, if 100 becomes 10,
correct,
then you need a 900% return,
correct,
to even break even.
Correct.
So if you are taking care of the downside, market will give you opportunities for the upside. So different people play different games. We said we are in the test cricket version of the game. So someone wants to play 2020, good for them. It's entertaining. But we would rather play the long form of the game.
I think test cricket has also evolved. People now want a result in the match. So your job becomes even that much more difficult, right? You're still sticking to the pristine old school thought process. Whereas even in Test cricket, people are saying, why is the result not coming in? But thank you so much for sharing that. Neil, I want to come back to you. 2016, you are setting up this company. You set up this entire thought process. You started investing, and you're looking at the investment landscape. I think sometime back you gave this analogy about the tiger. You said that if you're in a forest and you see a tiger, what can you do? Whatever needs to be done will be done by the tiger. I think that's pretty apt in terms of what happened in 2016 when demonetization was announced. Okay. And you were right there, fledgling AMC. What was your AUM at that point of time?
2016 would not be more than 700.
So 700 crores.
Yeah.
Okay. I think the pressures are different for smaller AMCs, the pressures are different for larger AMCs. Now, when you're looking at the landscape out there, okay, one is to manage your own thought process and building the institution. What did you see out there? And from a vantage point of being an asset manager, what was competition doing? How were investors reacting? What was your own thought process?
Yeah.
Give us some insight into that.
I think initially when we launched, and the next 2-3 years for us, actually not more than about 5 years was something, and we kind of knew that we were a mutual fund without any bank parentage or corporate parentage or distribution network or any of those things. So clearly we were here for the long game. We're like, for 5 years, think nothing might happen. And hopefully if we, and only after 5 years they give you rating rankings, and people usually track, okay, after 5 years kya kiya and all that, So we're like, okay, we were in our heads, we were prepared that 5 years we'll just have to build the foundation. And while we were doing that, obviously a couple of things happened that time which were actually negative for our AMC.
Okay.
One was we got in, when we got our license, the net worth criteria was 10 crores to set up a mutual fund.
Correct.
When we were immediately, I think 6 months or a year after we got it, it was made to 50 crores. And we had 3 years to get to 50 crores, So it was like running a really, really tight ship. At that point, we closed down all our other businesses to concentrate only on the AMC, So, and whatever money we made, we plugged it back in, and, we didn't spend on marketing or any of those things, which we really still don't do it. But anyway, it was honestly zero expenditure, which was not required. Obviously, in 2015, our founder passed away. So again, that was a big jolt, and we didn't know how things were going to pan out. So I would say that the first 6 years was about survival. It wasn't about growth. Wasn't about looking at what is competition doing, or what is somebody else doing. For us, it was that keep doing the same boring things consistently well, and hopefully there's light at the end of the tunnel. And at some point that will happen, as long as we're consistent. Just don't do anything foolish, Do what we were supposed to do and do what we set out to do, and maybe we thought it'll take 3 or 5 years, maybe now it'll take 7 to 8 years, you give away 2 or 3 years more because of all these things that have happened. And sure enough, I think we also at the right place, the right time, in terms of all the things that happened post 2016 were very positive for the industry. And obviously, we made a good track record, and kudos to Rajiv and his team for that. Again, from performance basis, from the communication base, I think people, and what we set out to do was get people who are sticky with us, sticky investors, sticky distributors. And these people, and our whole thing was that, listen, it was long-term, equity is long-term investing. So even the investors or the distributors we wanted them long-term, for a very sticky and for a very long-term. So we thought that even if there are few, they're sticky, they will give us, and we'll slowly grow this niche, And I think post 2018-19, post COVID is actually where we saw some decent growth coming in. So it took us about 8 years to get to that point where we think about what is competition doing and what is anyone else doing. I think in the beginning it was just about survival.
It's interesting you mentioned this, and this is the part about Indian entrepreneurs. I was part of the mutual fund advisory committee at that point of time when this went from 10 crores to 50 crores, and I was running an AMC which was also a small AMC. I was representing the small AMC fraternity, and I could immediately empathize. But I guess what you are talking about is a little deeper than what I could sense at that point of time. And like a true entrepreneur, you said that I took some bets, I prioritized things, and I waited it out. sometimes for a small AMC, or rather most times for a small AMC, I've realized that the bet is in a growing industry. Do you invest more to grow, or you cut down everything, focus more on bottom line, and wait for your time to come? It's never an easy call. It's never an easy call, you know. And I think you rightly mentioned we all got lucky at some point of time. But at that point of time, when you're in the thick of things, I think the whole industry, largely it was with smaller AMCs. I think small and mid-sized AMCs, not the size that we see today. In fact, he mentioned that we got lucky, and I just want to ask you the next question. Nobody anticipated the flow of money which would come in post demonetization. I think largely people have forgotten that. When you were managing money, A, from your own point of view, and B, from an industry point of view, did you think that at that point of time, the flow of money which is just gushing in is going to deepen the markets? Okay, or is it going to distort? Because honestly, I don't think anybody realized that whether this is very long-term money or not. So when you were looking at the landscape, do you think that it would deepen the markets, it would get more and more people, it would become more structural and stable? Or do you think that we are on the precipice of a distortion which might be happening? Your thoughts?
So, firstly, whenever a thing happens like demonetization, which has a very acute, in medical terminology, very acute impact, which is short-lived but very severe.
Yes.
We love those kind of events.
Please explain a little bit more.
Sure. So, demonetization will affect buying power for a quarter or 2 quarters.
Mhm.
So, obviously, people will have to exchange their currency notes. And if someone has undeclared wealth, then probably that will not come back to the system. But that in any way was not reflecting in the formal economy. So, let us say people have vehicles, personal vehicles. Let us say you have a car or a two-wheeler. If there's a puncture in the tire, would you throw away the vehicle? Answer is not. That's an acute problem.
Hmm.
Causes you a lot of discomfort, but it's fixable
Correct.
down the road, and things go back to normal pretty quickly. So whenever there are these problems which have a 3-month, 6-month impact, which causes stock prices to fall anywhere 20%, 30%, 40%, we love those kind of situations because it's the equivalent of people throwing away the vehicle for a punctured tire.
Mhm.
We say we will wait it out, we'll let things get fixed, and then obviously the utility is much more. So that was one thing that we saw about
Hmm.
the demonetization. To your question, did we see the size of flows? Answer is no. No one can precisely calibrate how much money will come or not come. But this phrase, informal to formal, has been part of financial media, sell-side research, fund management since a long time.
Mhm.
And this was one step in the entire journey. Jan Dhan, Aadhaar, mobile, the common KYC, demonetization, introduction of GST, increasing of the tax slabs where people are encouraged to
Yes.
disclose more income and pay a small rate at the early levels of income. All these have resulted in more and more formalization of the whole economy. So we saw that as
Hmm.
one step in the journey.
Hmm.
Another very unintended consequence of demonetization. That, to my mind, that was the first thing in what I'm trying to explain. Demonetization was one. GST introduction was the second one. India-Pakistan conflict, India-China border tensions, all these were India-specific events,
Hmm.
which don't affect global markets so much.
Yeah.
So this India plus global, the foreign allocation, which reduces the portfolio volatility, came to fore when these India-specific events happened. So
Yes.
this question of why, when India is such a high growth country, why do we even look at foreign markets, partly got answered around these events. Why? Geographical diversification is important.
Now, I must confess, I was one of the people questioning that. Okay, because to my mind, and you know, when you are seeing the growth of India, you always tend to think, as a practitioner, more as an investor, you know, कि why should I look beyond India? क्या इंडिया में growth rate कुछ है नहीं? And I think honestly, that is the time even I questioned, and like most people did. But the answers came in thick and fast. You mentioned a few things which worked for us, and Neil, I'd just like to ask you. It's like you were thinking कि एक दिन पहले pitch ऐसा खेलेगा और जब जाते हैं तो pitch एकदम differently खेलना शुरू हो जाता है. You're not prepared for the pitch, right? So what do? You look for some inspiration, you look for some miracle, and like Harmanpreet Kaur brought on Shefali Verma. I think one of the things which really helped the industry, to my mind, was the mutual fund Sahi Hai campaign. Yeah, I think it was 2016.
Yeah, 2016.
Yeah, I remember that I was on the Amphi board and there was a huge discussion.
Yeah.
Because 2 basis points was a big amount.
Uh,
Okay, and the thought process was that why should we not spend this on our own? Why should we look at it at an industry level?
Yeah.
But eventually, thanks to a lot of discussion, good sense prevailed. To my mind, that was a Shefali Verma sort of a master stroke. Again, you can think you were lucky in hindsight. But from your point of view, do you think that this was a trigger which actually streamlined the flows coming in post demonetization? Give us some sense of what you have seen in terms of the impact, what you saw it then, and how it has played out since then.
I think what it did, and again, 2016 we started, but the true effect came a couple of years later, 2-3 years later. But
Yes.
it gave it mainstream kind of visibility. With Dhoni, Sachin, Rohit Sharma,
Yeah.
you couldn't have celeb endorsing mutual funds, individual mutual funds, but
Correct.
when celebs are saying mutual fund sahi hai, and these are heroes of India, people will take notice of that. And what it did, it got visibility.
Mhm.
Acha, the curiosity. Oh, what is mutual funds? Okay, let's see what can happen there. What other thing that happened at that point, which I think was very important, and again in that time a lot of things happened, which was very good for the industry. I think the SIP culture started. Today also, when you meet people, they don't know what mutual fund is. They know what SIP is. So they think SIP is a product. So that SIP culture started building up at the same time when mutual fund sahi hai. Again, over the last other than COVID, the little down market and then it rebounding, people have not really seen a bear market or a place where money has been lost, or a 2 or 3 year period where they've not made money. And by that time, things also started working in the favor. It was 2017-18, the IL&FS crisis and all had happened, and then again things were moving pretty well up. So I think all these things, just like the moon, stars and the sun all aligned together, and it made it a very compelling product over the next few years. And when COVID hit, it was, I want to say this, it was obviously bad for a lot of people, but for the industry it was amazing, because people were sitting at home, didn't know what to do with the money, and a lot of that got channelized into mutual funds and obviously also direct stocks and stuff like that. But it became extremely mainstream around that time. So I think these 2 or 3 things really at that period really helped us just go to another stratosphere.
Interesting. You talked about COVID, and I'll circle back to that later. But you mentioned about the mutual fund Sahi Hai campaign and the sort of understanding of the investors which started changing at that point of time. Rajiv, when this whole mutual fund Sahi Hai campaign started up, you mentioned a few minutes ago that the average stay of an investor in your portfolios or at an industry level was 2 years. A few years before, there was an informal survey which was done, which talked about the fact that if an investor comes in through the debt markets, if he comes in through an income fund and later on graduates towards hybrid or equity, the average stay could be as high as 9 to 10 years. But if somebody comes in equity directly, that is when I think the problem happens. And that typically happens when somebody comes in at the peak or close to a prelude to a correction. Now, post this mutual fund Sahi Hai campaign, when you look back, do you see the investor behavior having changed, the average tenure having gone up? And how has it helped you in terms of you as in you and your fraternity in terms of managing money? How has it helped, or what insights can you share with us?
I don't have too much good news to share here, unfortunately.
Okay.
So I don't think there's been, at least the data that I am seeing, I don't see there's meaningful change in the holding period of equity mutual fund schemes. So what has happened is, you and I are old enough to remember physical share certificates.
Correct.
By default, everyone was a long-term investor, because if you took delivery of shares
Yes.
and you sent it for transfer, it would take 6 months till you got the shares in
Come
your
back
name.
with the signature mismatch.
Yes, and if it came, it became a year.
Yeah.
Today, in a T+1 settlement, you are free to sell after 2 days. Uh, transactions happen at a click of a button. So at one end, while we are celebrating 1.7 lakh crores worth of capital raising through IPO markets, at the same time, we have 1.07 lakh crores worth of retail losses in the F&O market. And some of the real money gaming people are pivoting to discount stock broking. So they are effectively viewing these things as fungible. So this whole thing of get rich quick or leverage or do same day option expiry, I don't think we can conclusively say that investor behavior has changed for good, especially in the direct capital market related products. Sure, at the back end, a lot of good work is happening. EPFO has started investing in equities. That's real long-term money. A lot of NPS money is coming in. That is longer-term money. But this thing of giving your stocks time to deliver returns or giving your mutual fund schemes time to deliver return, somewhere that has become short-term oriented or remained short-term oriented.
Okay.
I don't think the
interesting.
horizons have meaningfully increased.
That's interesting because I would have thought that basis so much of education, while the number of new folios have come up and there are newer and newer investors coming in, what you're saying is that an average equity investor, whether it's through a mutual fund or otherwise, will tend to, at times get distracted by the noise which is happening and maybe react in terms of either stopping his SIPs or pulling out money.
So let me give you a data point. I think March 2020, if I'm not mistaken, there were around 4 crore demat accounts in the country.
Yeah.
That number is close to 20 crores now. Now, a lot of it could be duplicate accounts. Or even in terms of unique mutual fund investors, there has been probably a 50% increase from pre-COVID to now. So, a lot of investors have come in the last few years. These people have not seen a sustained down market. So, people forget that in India, after the Big Bang reforms of 92 under Mr. P.V. Narasimha Rao and Manmohan Singh, industrial licensing being abolished, foreign institutional investors being allowed into India for the first time, all of that, for 11 years, market went nowhere. BSE Sensex was at 4,200 in Harshad Mehta peak. March of 2003, Sensex was 2850. So this was an 11-year period. Even after the global financial crisis, markets took a while to go back to the 2007 peak. So in the last 5 years, people have not seen Neil referred to it, people have not seen a sustained down market. COVID was a brief blip, and like 2020 still managed to close on a positive note because of the sharp recovery. So I'm not so sure that the end investors are coming in with the expectation that there will be periods of zero return, there could be periods of negative returns. There is some element of chasing the latest hot thing. Recently, chatter is there that, oh, people do all this analysis and all that. Men went and bought stocks and mutual funds, whereas the smart women of the household just bought gold and they are doing so much better. So now there was this thing that gold and silver are the best things to hold rather than buying equities. 1 year of flat to negative returns, chatter has started.
Yeah.
So
no, it's interesting that you mentioned that. I think we still do get carried away by a lot of noise. And I tell most people who ask me one advice, what should you do in the markets? I say turn off notification when on mobile. That is going to be the first thing to cut off noise. But you mentioned a very interesting thing about SIPs, and I'm just going to ask you the next question, Neil. You call it SIP, I call it SIP. I think it's a generational sort of a thing. I just can't get myself to call it a SIP. But you're right, it's become a new word in the lexicon in terms of people's understanding. this decade has actually seen the growth of impersonal distribution channels, if you will, where there's no human element involved. You've seen the growth of fintechs, even erstwhile distribution channels which were talking about it, talking about mutual funds. There's a lot of digital servicing, digital onboarding, digital information, etc., etc., etc. Two questions. One is, how has this helped to grow the industry, and how has it affected investor behavior? If you could give us some insight.
I think it's been really, really helpful for mutual funds, smaller mutual funds. Again, guys like us, for example. So I mentioned earlier that we didn't have any distribution network, or we didn't have any branches, or we had nothing. We didn't even have any backing for corporate and stuff like that. I mean, the fintechs really helped us to go deep. I mean, the fact that if you would communicate well and your performance was well, and like you mentioned, it's always about the performance. So if the performance is there, you would see a decent amount of money coming in through that. And I'm hoping, I'm a little more optimistic that people are actually doing some research and saying, okay, these guys are reasonable. I can put my money here. I can do a 10, 15, 20 year sip with these guys. So I'm hoping that that is there. But obviously, from a behavioral standpoint, we don't know how these people are going to behave, to be very honest. These are actually, most of them are people who've come in during the 2000, at around COVID time. And it's been 5 years where it has not seen a bear market. 1 year, we are seeing some flattish market, but we need to see what happens 6 months, 1 year down the line. But obviously the propensity to jump from one fund to the other fund, because it gets flashed on your screen that despite exit load. I mean, I don't think they even know sometimes that there are exit load. I don't think they read fact sheets, most of them. But I'm thinking there are both sides, both people. I think there are people who are sitting in tier 2, tier 3, tier 4 cities who are really genuinely interested. And we've met people like this, younger generation, and they are just very interested in this, and they have read so much, and they are on top of things, and they're like, you know what, this, I want to do a 99 year sip with you. And they're doing that. On the other side, there are also bad apples. So I think the behavior is a bit mixed. What it's done for fund houses like us is that, and I'll just give you a data point here, that 1/3 of our AUM, total AUM, comes from fintech plus RIA. Okay. So, and fintechs is about 23, 24%, almost 25%. A quarter of the AUM of ours comes from the fintechs. Now, the second data point is, out of that 100, or out of our total AUM, 24% comes from B30 cities, beyond 30 cities. It's 24.42, if I'm not mistaken, which is the highest in the entire industry. More than the ratio of SBI, which you would think has deep down. Yeah. And we don't have presence in one branch. We don't have a presence at all in any of these cities. Not one person, not one branch, not anyone trying to service these guys. This is just happening for reason. I'm optimistic that it's for the good reasons, that they think that we are reasonable people and will manage their funds well, and they performed well, and there's some consistency towards it. My downside's protected, and whatever else we kind of want to communicate, I hope they're hearing it somewhere and they're investing in that. So I think it's really helped, made a kind of a level playing field, if you might, between mid-sized small AMCs compared to with the large AMCs. So I think that's really helped out, at least guys like us.
It's very interesting. In cricketing parlance, you could probably say it's unusual field placements, right? So this has completely changed the dynamics, is what you're saying.
Yeah.
It's nice. It's nice to actually see. And while you're talking about not having a presence in some of the branches, I think it's worthwhile mentioning that you and your teams have got the largest flexi-cap fund in the industry.
Yes.
So obviously somewhere things are getting flashed in the right way. Maybe a side question is, at one point of time there is Morningstar and Value Research, and they still publish data. But I guess these fintechs are now bringing it right down to your mobile, and you are looking at them while you're looking at other things, which is what is inducing a change in behavior. Very interesting. So talking about unusual field placements, and I'm talking about the fact that you're actively managing an actively managed fund, which is 1.45 lakh crores.
This would be about 1.2 I mean, total AUM of all 6 schemes are 1.43. This would be about 120.
Okay, so I'm a little precise. I'm saying jaldi ho jayega. 1.5 lakh crore jaldi ho jayega. And that is one scheme which is the largest scheme. I recently read that, let me just rephrase my question. In this day and age, when you're talking about passives, and passives have really grown, okay? For an actively fund manager, you're actually watching what's happening out there in terms of passives, in terms of target-linked maturity funds, etc., etc. So, two parts to the question. One is that is passives a significant sort of a segment at this point of time, which A, probably is helping to build the entire equity category, but is taking the attention of people like you who are managing actively managed funds. And B is that in a country like India, which is still growing and price discovery is still happening, okay, what do you think is going to be the role of passives? And, maybe I'll ask either of you a question whether you're getting into passives in the first place. But the first part of the question is your view on the growth of passives and how it is sounding to you like a active fund manager.
So mathematically, let us say in this entire room, half of the people were active investors and the remaining half of the investors said, we will be passive investors. And these were the only investors in the country. At an aggregate level, the portfolio of active managers would be the same as portfolio of the passive people.
Okay.
Because let us say passive people owned 50% of SBI, 50% of TCS, 50% of Reliance, or every listed company.
Correct.
And active guys
Would own the other 50.
would own the other 50%. So you may own Reliance, I may own HDFC, he may own TCS in different weightages. But at an aggregate, both segments will have the same portfolio. Active guys will pay more fees and will pay taxes on each churn. So they will mathematically get a lower return than the passive guys. So that's at the very, very aggregate broad level. That's the argument for passives. There are arguments against passives. So one is, as per law, you can legally front run passive mutual funds.
As per law, you can legally front run passive mutual fund. Okay.
So,
Please.
so NSE will issue a circular saying with effect from such and such date,
this is coming in the
index
Yeah.
will include these stocks
Yes.
and it will exclude these stocks.
Yeah.
So in last half an hour of that date, the passive funds sell the outgoing stocks and buy the incoming stock. And the entire market has front run those. So not only for Nifty, but even MSCI or any index, the changes are announced well in advance and the entire market has front run. Obvious money left on the table, passive funds cannot take that money. So if futures are quoting at a discount to spot market, they cannot, because by mandate they are forced. If there's a merger arbitrage, they cannot. So there are some things which are wrong with passive funds as well. So the other thing for a economy at the national level, what is the role of capital markets, equity markets? It's capital formation,
Correct.
channelizing savings of individuals to formation of companies which can grow the economy, provide employment to the masses. By definition, a passive fund cannot invest in a new company or cannot invest in an IPO.
Interesting.
First, the company has to get listed, have a market cap, meet the exchange criteria or the index committee criteria, and only down the road somewhere come into the index. So, in markets which have gone majorly passive, the primary market has had a severe downturn. So, one of the reasons attributed to a vibrant primary market in India is the presence of actives. So, both have their pluses and minuses. For us, one, we are obviously focused on the active space. But on the passive side, we are trying to do it a bit differently. We are trying to combine best features of both passive funds and active funds and trying to create a product architecture. So that's somewhere down the road.
Interesting. While you were talking about active and that argument, our common friend Praveen, who's a very high-octane passive fund supporter, I'm sure he would be listening to this podcast later on and making notes and calling you and arguing this back with you.
No, I have no argue. So I gave
But-
the bull case right up front for passive. So I am a fan of passive funds as well, but they can be done better. Is my
I understand.
hypothesis.
Most people who defend passive are not as diplomatic as you are. So talking about actives and passives, I think the whole economy went into passive during COVID. You talked about COVID some time ago. Uh, I think it was something which entire generations had not seen. So there was no precursor, there was no pretext, there was no playbook. You didn't really know. So most people think that 2008 was bad. You don't know whether your company will survive or not. Here, you don't know whether you will survive or not. I mean, it was that bad. In that sort of a period, you had people getting in aggressively into equity, the formalization part of equity, the FNO part of equity. Okay, did that catch you by surprise? Did that amaze you? What were your thoughts when you're looking at an industry level? What were some of the things which you think competition did, which really augmented the entire growth of the industry? If you could just share a few thoughts.
Yeah, I think one of the main things of COVID was that communication became a lot better. You had no choice but to communicate and communicate openly. I think you saw the on Twitter, fund houses came there, started doing, started answering questions and queries, and it became more open, more transparent. I think got transparency in the industry. It helped in it massively helped customer service, because everyone honestly at home was a customer service support person.
Interesting.
Like from top to bottom, we all were kind of trying to solve queries or whatever it is. People only had our number because we were all sitting at home, and he's like, what happened to my this thing? And we would try to figure it out. I think that also led to customer service becoming amazing. And one of the things was the fintechs, right? At a click of a button, you could buy things now, and the onboarding was so easy. And that the behavior there was that if onboarding is so easy and something happened to my portfolio, I want real-time answers. Don't tell me it's this one, it's this the registrar's fault, this one's fault. I want communication. So people expected communication at almost a real-time kind of a thing, or they wanted their query solved on Twitter. They would write to you and you need to do it. And the bad part was that if you didn't write back, then people could just write anything about you, right? I mean, it could lead to reputational risk, or it was a headache that you don't want to take. So you had no choice but to become really good customer service people, have transparent communication. Also, it led to the tech experiences or the investor experience being extremely, I think over the next 5 years became really great, because we needed to have our own onboarding. Obviously, there are people who come through distributors, people who come direct. Distributors want to also now do onboarding. There are corporates who want to onboard and do liquid fund. So we needed a proper stack of that. The tech stack had to be really good. A lot of effort, I think, of the industry went into how do we make it as easy as possible? How do you make onboarding easy? How do we make the whole customer experience easy? And with that, customer support also needed to grow. So I think transparency, customer support, and tech, the in-house tech really all really took off in the last 5 years now.
Very interesting. I think one manifestation of that has been the growth of a tool like Zoom. Nobody had heard the Z of Zoom before that, and then now it has become, everybody says, let's have a Zoom call. It's become almost like, but Rajesh, you talked about communication, and I'm just tempted to think at that point of time, if I were in your shoes, what would I be talking about? See, the local markets, everybody knows, everybody has a view on, but you were also investing into global stocks. Okay, the communication part of it, the explanation part of it, the justification, if you will, the part of it, and telling people to stay the course would have become even more difficult, because that's something which most people would not even have too much of idea about. So how did you and your peers who were managing global stocks take this forward, talk to people? What was the communication process which you had?
Sure. So I'll talk about the general communication and then specifically about the foreign stocks. So in the early days itself, there was a realization that COVID is bad for the health of the elderly, people with comorbidities, and in very, very age cases, it would affect healthy young people. Otherwise, healthy young people or even middle-aged people, elderly people in good health would have symptoms of flu and
Interesting.
other things, and they would recover. This was known even in March of 2020. And at that time itself, it was known that work has started on vaccines. And it was known that eventually everyone will get it. And once you have had it, it builds immunity for the next round. Even absent vaccines, if you have got it once and you have recovered, then your risk of the second inflation is that much lower, or at least the risk to life is that much lower. So this straight away fitted into the acute
Impact.
that we spoke about earlier, where 6-month earning, let's say, could be terrible. Maybe 12-month earning is terrible, but it's like a flat tire on your car. You don't throw away the car because of that. Because of this situation, stock prices fell 40%. Now, 1 year's earnings obviously does not have a 40% impact on the discounted cash flow or in the actual business value.
Correct.
So we communicated this to investors. We acted accordingly. So most of us ran down our savings account, FDs, put all the money into the scheme. Before the COVID struck, we had about 13% cash that we ran down to 2-3%, whatever bare minimum we could keep. And we communicated to clients, if you have investment capacity,
Put in money now.
be greedy when others are fearful, to quote Buffett. Foreign stocks, incidentally, the ones that we owned, were the biggest beneficiaries of COVID.
In terms of price, in terms of earning,
In terms of business.
in terms of business.
So, one of the companies we owned was an e-commerce player. So, at a time when physical stores are shut, 100% business goes to e-commerce. These were players in the streaming entertainment. Now, when sporting events, musical concerts, movie halls are shut, what did people do? Massive rise in OTT, video consumption, music consumption. When newspapers are not being printed, when outdoor hoardings are irrelevant, entire advertising moved to digital. So the 4 companies that we owned were right there to benefit from the shift towards digital. So they were among the biggest beneficiaries of the...
And this would largely happen with most people who are managing global money either directly or through fund of funds, or was it something which was unique to you?
So partly the portfolio was structured in such a way that the longer term trends were anyway benefiting these companies, but COVID just accelerated it put the trend on steroids. So if someone was owning a global airline or a bank, then obviously there would be a adverse impact.
I can't help but smile while you were talking, because I read an article around that time in Bloomberg Newsweek, which talked about the fact that lawyers' fees went through the roof because divorce cases shot up. Because you talked about communication, this was communication of a different type. The husband and the wife were never in the same house, and suddenly they are stuck together.
Yeah.
And they realize that he's not the same person. I mean, it can go on and on. I'm now coming to the final overs. Okay. And I'm taking this deep. I'm not into pinch hitting in the final overs. A couple of questions just to wrap up this entire conversation. Your growth strategy has always been to connect directly with investors, and you've mentioned as much. I'm very tempted to ask you, while you were doing this and direct plans that come in, and you were taking a lot of unconventional bets, how did this pan out in terms of your relationship with the distribution fraternity, advisor fraternity? You mentioned RIAs. I'm saying, let's take RIAs aside. The MFDs, how was your relationship with them? How did they take this fact that you were talking to investors directly? Give us some insight into that.
Yeah. So it took time to convince distributors. Obviously, people who kind of little bit knew us and who knew Dad, my father, whatever, the founder, Mr. Parag Parekh, they kind of had read his books, some of them, and that's why they had started with us. I mean, there was no real track record. I mean, some people obviously knew about our PMS, but generally, it was slow. The first, like I said, the first 5, 6, 7 years were generally slow with everything in our mutual fund. I mean, we hit 1,000 crore AUM only in 2018, 6 years after we started.
2018, 1,000 crores, 2025,
No, I mean, yeah, 140.
140.
Yeah. So
Talk about compounding. Eh?
yeah, exactly. So yeah, so it was really slow. Obviously, distributors initially had questions that no one's doing a unit holders meet kind of a thing, and
Correct. Correct. I'm sure. Yeah.
this thing you guys should not do. And the other thing we did, which was very controversial at that point, and I believe we're the only people who are still doing it, is that we gave everyone one commission. We didn't have differentiated commission structures. So that kind of didn't sit right with some people, but some people also loved it. The smaller guys probably loved it, that they've been they don't want to look behind their backs and see that, oh, who's getting more, who's getting less. It helped our team internally when they went to meet the distributor. I mean, this is over time, that now nobody even asks us about commission. So we can talk about things that really matter. Otherwise 80% of your time goes in negotiating commissions and fees and all that. So now people know that these guys are not going to give me anything more, and everyone is at the same kind of level. So initially, a data point, again, 2015, 16, 17, you take any of those years, our AUM through distributors, where we pay a commission, was about 8%.
Oh.
92% was kind of direct. 8% was distributors.
And the AUM was also small at that.
It was small.
Hmm.
Today, distributors contribute 40% of our AUM. So I don't think it has affected them. It was all about us communicating with them. And you know what? And even in the unit holders meeting, the distributors are also invited. It's not like only the unit holders are invited. We invite everybody, everyone who's invested with us and the distributors. Please come, please ask your question. This is nothing more than just a session where, we build trust two ways. We set expectations right between what we expect of you, and you should hear from us what we expect probably from the market and what we think about different stocks or whatever that are in the portfolio. And that was about it. And I think over time, people realized that this was great, because even if they, and it was recorded, all these events. So even if the investor wanted to know something, they could take a snippet of the unit holders meeting and say, okay, this is what it is, I think it's helped us overall with the distributors. And that shows today in the numbers, I guess, so.
Interesting. Ajiv, I want to wrap up this thing by asking you a question. Again, which has got two parts. So with you, I don't know why I tend to ask a little bit more than this thing. The first part is now the fact that you cannot invest as much money globally because of certain restrictions, from the regulators, from the RBI. Your portfolio would have a preponderance more of Indian equity than global equity. Do you think it is now just like any other fund, and your competitive advantage in terms of having overseas equity has probably gone down? And two is, he's talked about investor behavior. He's talked about people coming and talking to you at the AGMs. A lot of positive vibes start coming in when the performance is good. Now that this is structurally changed, which is not in your control, but it has structurally changed, and God forbid if something happens to the performance, okay? I'm being very candid with you here. Do you think that the same investor behavior, because sometime back you mentioned that investor behavior is fickle, can be fickle, would be fickle, right? And this is probably across years of experience that you have. So what is your game plan in terms of managing this?
Sure. So, very, very interesting questions, and probably I'll take a bit of time answering both these things. So, a lot of people think that the FlexiCap fund has done well because our foreign stocks did well.
Okay.
I don't have the number as on date, but sometime back when we had done the numbers, both the foreign stocks and Indian stocks had done better than our benchmark and the Nifty 50. So our benchmark is NSE or Nifty 500 and the second benchmark is Nifty 50. So both the segments, foreign as well as Indian, had done better than the benchmarks individually. But among these two, the foreign and the Indian, barring the last 3-4 years, typically Indian stocks have done better than the foreign positions. So it's only off late where, so last 1 year where US market has done well and the Mag 7 of Nasdaq have done really well.
Mhm.
But it's mainly a last 12-month phenomenon. And this period of underperformance, it has come numerous times. So I referred to the COVID period where the foreign stocks benefited a lot. So 2020 and 21, we benefited from that tailwind. 22 was when actually those companies were not doing well. And we had a year where we were marginally in the negative, somewhere around 2 to 5% negative on a 12-month basis. And we were not beating the index in that period. We still did the AGM. A few people were upset. We explained our thing. And the severe underperformance actually came pretty early in my career. So I started managing money professionally in 2003. And 2007 was one of the worst years for me in terms of performance versus the benchmark. So in the portfolio management service that we ran, we were not buying the real estate companies, the infrastructure companies, the commodity companies, which were doing well in 2007. But in the 2008 crash, we did not fall 80-90%. Like some of those companies went
Correct.
bankrupt.
Correct.
Or all the money was
Rule
lost.
number 1, rule number 2.
Yes. So
Yeah.
we have been through these cycles. Our founder Parag Bhai himself went through this cycle in the late 90s. He was not participating in some of the dot-com companies. And things were so bad, he said, let me take a sabbatical. Let me just go to Harvard and do this new course that has come out on behavioral finance. That's where he got introduced to the new subject of behavioral finance, and he went deep into it and did some original research, authored 2 books, wrote articles, gave talks. We have had these cycles numerous times. So last year in 2 different media interviews, one which Neil did, one which I did, we said we are okay to underperform the index because we will not invest in things that do not make sense to us. Again, we said we would rather lose half of our clients and half of our AUM rather than lose clients' money by doing stupid things.
Oh, interesting. And thank you for sharing that candidly, because and note to myself, I have to be part of your AGM. I would love to hear that, during a client info, this thing. I think one of the learnings I get as a professional, as an industry practitioner, again and again, is to not think in months or years, and to think in decades. I think you were mentioning this sometime earlier, right? Which actually just puts things in perspective. The closer you are to the mountain, you don't know how big it is. The moment you start stepping back, I think that was a very nuanced answer. Some of us would probably still want to have a high momentum strategy, but some of us would then say, okay, I will go more by comfort than conviction. So thank you so much for sharing that. Before we wrap up, I think the students here have been listening very patiently, and I'm sure that there would be a few questions. There are questions, right? Yeah.
Carrying a great image of your late father, Sir Parag Parekh. And other question for you. You, Sir Rajiv, sir. Sir, gold and equity are meant to be moved inversely, but nowadays both of them are touching their 80s. So what are your thoughts on that, and what are retail investor like us should be doing in this?
I just remember when I was on the flight back to the US when after my dad passed away, and I was going there, and all these things just started going in my head. Okay, this is what he used to say. This is what he used to say. I wrote down a few things that okay, these are the things that he really cares about, and he would really want us to go. This is what his vision was, and I'm like, you know what? I'm not going to try to reinvent the wheel. This is what he wanted, was going well. And let's just stick to this. Again, a long term kind of a thinking. I mean, think in decades, don't think in months, years, and all that, you know. Um, don't work for money, make your money work for you, means keep investing, and you give that to other people. You impart that knowledge to other people, younger people, that okay, this is the way you're supposed to do things. The other thing is that investments are supposed to be boring. The day it turns exciting, you're not investing, you are gambling your money. So again, holding your urges to delay instant gratification, I think it just created, it was already there in some form. My job was just to strengthen it, to be very honest, you know, and I already had all those pieces. And obviously the nothing happens without a great team. So even when all this happened, our team stuck together, you know, whoever was there, and everyone helped each other. And I think we all had a very similar vision of where we wanted to go. Everyone thought alike, in terms of alike in the sense that what we need to do now. We had patience. That was never a question, you know, about having patience, and okay, we'll think in terms of 5 years, 10 years kind of a thing. And everyone had a shared vision, shared culture. Culture was very important in an organization. It's a very collaborative culture. So one of the things we do is that we don't give targets in our organization, which is very um, I mean, in a financial field, how do you not give targets? Because everyone does give. So we said we're not going to give targets to people. Also, it leads to a collaborative culture. Everyone's helping each other. There's no internal competition or politics, you know. I mean, politics are there, obviously, sometimes. You can't say no to that. But competition becomes as less as possible, and people help each other out. And that actually gets the whole organization growth going, you know. So I think these are few things that actually helped us.
So historically, it's managed to keep its purchasing power intact, but it has had decades of zero or negative returns as well. So gold is a very, very difficult asset to assign a value to, and I'll tell you why. Whether it's gold, silver, platinum, Bitcoin, uh, piece of art like Mona Lisa, see, these assets don't have any inherent cash flow. 5 years from now, what will be the price depends on what two individuals will decide and what price they will transact at. So, as investors, we focus our energies on things with cash flows, whether it be equity, whether it be bond, REITs, InvITs, aircraft leases, whatever, warehouses. If there's an asset and there's an inherent cash flow, you can make projections. Is this providing a good or a service to someone, and can you monetize that? Uh, of course, gold has been part of people's asset allocations historically in India, but we don't have any specific view on the asset class as such.
China is buying gold. Other countries are piling up gold. Dollar has lost 10% of its value. Warren Buffett, Berkshire Hathaway has, in 2022, it had a cash pile of $150 billion versus now it has $350 billion of cash pile. So do you think, there is a bubble, or, global markets might correct in the near future? And do you think India will have a ripple effect of that?
In India as well as globally, absolutely. There are some areas where I can't make sense why is this company valued at so much. So internationally, let's say a few AI researchers from the big AI companies, they quit their jobs and they start a new company. Immediately, that company starts quoting at billions of dollars of market cap. Does it make sense to me? Answer is no. Does it mean that you sell everything and put money under the mattress? Again, the answer is no. So, in every or almost every bull market, there are pockets of excesses there are pockets of attractive valuations. So if we look at the past markets, late 90s, there was this dot-com boom. At that time, whatever was called old economy was actually attractively valued. So you could buy consumer good companies, you could buy banks, could buy paint companies or pharma companies or anything and make decent amount of money. But if you bought the overvalued dot-coms, then you ended up losing a lot of money. Fast forward to 7 years, year 2000 to 2007, what was in bubble in 2000 was actually attractively valued in 2007. So the Indian IT services companies, for example, which were extremely overvalued in 2000, were actually attractive in 2007 when the bubble was in real estate, infra and commodity companies. So again, you could have bought consumer good companies, pharma companies, and those kind of names. 2017 was a frenzy in small cap stocks, whereas larger companies were reasonably valued. So you have to find pockets of opportunities and you have to stay away from things that are frothy.
Sir, as the Parag Parikh Mutual Fund operates in very less variety of the funds in equity segments, and there are new age investors entering the market who are more attracted towards the aggressive funds. So, has the company any further plans to launch newer NFOs in the especially mid cap and small cap segment?
For us, there's like one strategy, one equity strategy that we like, and I said it in the interview, that a kind of a Swiss Army knife kind of a concept where we like diversified fund, where the fund manager has a lot of flexibility to do or go where value is. We don't want to be tied down by, oh, you're a small cap, you can only do small cap, because we are people who chase value as such, and there are times when there's no value in small caps or very little value in small cap and the value will be in large cap. So we want a fund that can move between these sectors, and just because something is and when you run a diversified fund, if anything is valuable in the market, you can buy it in that fund only. You can have higher. So there are times when we've got a very high percentage of large cap stocks, and mid cap and small cap will be less because we think that they're highly valued. At other times, we can change that allocation and make large cap and small cap much bigger, and small cap and mid cap much larger, and large cap much less. So we can have that flexibility of keep doing those things in one fund. If you're only a small cap fund, you have to invest at any given valuation, and which might not make sense. So it's just not our strategy to launch something narrow. We want it as wide as possible. Fund launches as such. So again, we keep saying that the only reason we will launch funds is on 3 occasions. One is if we can simplify the category, if we can bring some simplification in the category. Second, if we can get some differentiation in the category. So when we launched our Flexi Cap fund in 2012, there's nobody doing a 65-35 Indian overseas, so that got some differentiation. That was fun. And thirdly is if we are excited to put our own money in it. If we are only not excited to put our own money in it, I can't meaningfully go out and tell people to, boss, put in my fund, So we have, and we spoke about it, we have one fund launch that we are going to plan, and that is somewhere in what we call a semi-passive category. I mean, it's a semi-passive fund which will take the best of passive and active. And we see that there's no one doing it right now, and so we are waiting for a license to our approval to come for that, and we'll probably do that. So that's the only thing that's there. The other interesting thing that we're launching GIFT City funds, and GIFT City is important because today people cannot invest globally through a mutual fund route because the $7 billion limit has been hit, and we can't remit more money there. Through the GIFT City route, you can do the foreign allocation now, and you can launch retail funds as low as $5,000 or $10,000. Before, it used to be 75,000 to 1,50,000 used to be the minimum. Now that's come down to 5,000, 10,000. So that makes it like a mutual fund kind of a structure. So we're excited about the global funds that we'll launch from there. So these are the 2 things that we're coming out with.
My question is to Rajiv Thakkar, sir. In your last year's yearly message to your investors, you had mentioned quite a few things. You had mentioned about your worries about small cap. But there's one interesting thing that you also mentioned. You said it is not necessary that GDP performance is mirrored by the stock markets. And you said that if India's nominal GDP is 12 to 13%, then it is not possible for your industry to deliver the same results over time. So my question to you is, and what we are seeing currently is also, you predicted it right, that there are people who are saying that the equity market is saturated. It is not giving much returns. So my question to you is, what is the future of Indian equity markets henceforth? If is it saturated, what kind of returns will it generate, or your perspective, your analysis?
So there's a small leakage between a country's GDP growth rate and the stock market returns. Stock market returns typically tend to be somewhat lower than the country's GDP growth rate. Reason is for the share price to increase, the earnings per share have to increase. But for the earnings to increase, many times the companies have to issue fresh capital. So if your profit has grown by 20% and your equity base has grown by 10%, then EPS growth may only be around 10%. It may not be 20%. So there is a small leakage on account of fresh equity issuance. So many times the GDP growth does not translate into profitability for shareholders. So again, rather than worrying too much about overall macro, is there one particular company or one sector where you think it's available at this market cap? I see good prospects. This company has a good management team. They have the execution capability. Balance sheet is strong enough. There's not too much competition. They have pricing power. Valuations are reasonable. Go and buy that. So as a fund manager, as an equity research house, we may not have a view on each and every listed company out there. As long as we are able to find 25, 30 companies to invest in, we should be fine.
What an amazing discussion this was. We're talking about seeing the industry through the lens of two stalwarts from Parag Parikh Financial Advisory Services, PPFAS Mutual Fund. I keep jumbling around the names, but this is what it is. Like they say, you can break records and the scoreboard will keep showing records and they'll keep showing the runs. But the truth of the matter is you need to stay at the crease, you need to show discipline, and you need to have the patience to accumulate. And that, I think, is the basic message which is coming across for all investors. We started with 1995, we talked about it through the decades, but I think this core message has not changed. Like Rajiv pointed out and Neil was emphasizing, that the nature of the game, like in cricket, has changed. You move from test cricket to one day to T20, but what really matters is how much patience do you have in occupying the crease and playing the shots when it really matters. Thank you for being such patient listeners. Thank you so much for your time, and I look forward to hosting the next session of MF Chronicles very soon. Thank you very much.